Hey everyone, my name's Andy. I'm from Finding Value Finance. I'll be your host today. We've got John Polomny with us from Actual Intelligence. Thanks for coming on, John. Appreciate it.
Appreciate you having me, Andy.
Yeah, I think this is your second time on the channel, so thanks for coming back. We don't have to go through a huge introduction or anything like that. John, what's your current view on the markets at the moment? What are you seeing out there?
Well, I think I would predicate it with a statement that a hero of mine, Stan Druckenmiller, made that in the short term, liquidity and sentiment drives markets. And so I think that we are now in a uh, worldwide central bank easing cycle has started. It basically started last August. I tracked central bank actions. And initially, coming out of the pandemic, most of the central banks obviously raised rates to deal with the inflation that what came out of the pandemic with all the money printing and then lack of supply because shutting down the economies. And most of the emerging market and smaller countries raised rates first. The G7 countries were late to raise rates. They kept calling it transitory inflation. And so we had a rate raising cycle. Basically, inflation peaked, came down. And so at some point, real rates in a lot of these countries were very high. And so a lot of, like I said, last August, I saw a trend where month after month, more and more central banks around the world began cutting rates to lower rates as their inflation rates came down. And of course, uh, that's good, but not that I agree that with centrally planned central banks doing this, it's just what they do. But my idea was that would increase liquidity over time. But we really needed to see the bigger central banks, like in the G7, the ECB, the Bank of England, Bank of Canada, all these countries, and then of course the United States cut rates, the bazookas, if you will, to really get this going. So in the last several months, we've seen basically the bigger countries. You see the U.S. what they did last month and earlier, yeah, last month, and cutting rates, or this month, anyways, cutting rates. So basically, we have most of the central banks in the world cutting rates. We're in a rate easing cycle. You're starting to see global liquidity start to increase now. I would expect what will happen is I'm a big fan of Cantillon. He was a French writer in the 18th century, and he talked about the Cantillon effect and the effect of uh, how money flows through an economy. At that time, his advice was to be as close to the king as possible. Nowadays, you'd want to be as close to the money printer as possible. As we see this, basically, what the Cantillon effect is, you have a rise in liquidity being created by these central banks as they get into the bond market and buy bonds. I'm just speaking in general high level terms now. And then, that's kind of akin to increasing the amount of water or melt ice after winter in the headwaters of the Mississippi River up in Minnesota or North Dakota. You have this surge of water coming down. You can see it coming through maybe the Twin Cities, but down in Memphis or New Orleans, you really haven't got the effect. So as this wall of water or liquidity uh, moves through, you will see. Yeah, there you go. You will see begin to see. You don't know where it's going to spill over. Is it going to go over a levee in Iowa? Is it going to, cause a problem down in Vicksburg, Mississippi? It's the same thing with liquidity. You don't know where it's going to necessarily flow. We're seeing it started to flow in the stock market here in the U.S. has continued to make new highs. We've seen gold make new highs. We've seen some action in Bitcoin. It's been a little bit more volatile, but I think you're going to that's kind of what I'm looking at. I think what we'll see eventually is as bank credit and liquidity flows to the market, you'll start seeing. I will also watch global PMIs, Purchasing Manager Index, different countries. You'll start to see economic activity increase, um, and then as more credit flows in the economy, as they lower rates even further, and then hopefully what what I you know going down the line here eventually see more and more pressure on certain commodities. I think it's interesting to note that even before this whole cycle, when liquidity was bottoming, we still had relatively high prices for some of these commodities. I mean, copper, basically went under four for a little bit. Oil hasn't fully collapsed. Some of these other things really didn't pull back like you saw in previous times of when liquidity tightened. So I'm very bullish and optimistic about certain resources, and uh, I use the term super cycle, I think, for several reasons, not just liquidity. We're probably going to be in a super cycle for commodities. But yeah, I don't. I had a view because of rates being higher last year that we would enter a recession, but with the fiscal spending that the U.S. has done, and which I don't agree with, but that's what they've done. I don't really think if we do see a recession, maybe it's a slight one. We were in a recession in manufacturing. That goes without saying, but manufacturing is only 12% of the U.S. economy at this point. So overall, I think what we're going to see is this wall of liquidity make its way through the global economy, and I do think that it's very likely that maybe down the line a year or so, we're going to see an increase in inflation, and then we're going to have more of a problem. But as applies to the markets that I care about, yes, they will. They are influenced by liquidity in the short term, and obviously, then as markets make new highs or acknowledge being bull markets, that makes sentiment more positive, and then you start getting a self-reinforcing loop. So that's kind of my idea right now.
So I'm gonna ask a difficult question because I don't know this answer either. So we'll get your opinion on it. Um, so here it's a two questions. Do you think a recession slowdown is going to come before the wall of liquidity comes into the market? That's the first one. And two, if the wall of liquidity does come, can we still have a recession even though liquidity is going up?
So I think what the mistake a lot of us made when we tried to play economists was looking at previous cycles and then seeing how quick that the Federal Reserve raised rates, basically from 0 to 500 basis points. And we did see, like I said, we did see some problems in commercial real estate. We saw some problems in manufacturing. Manufacturing was in a recession in the U.S. It's still pretty weak around the world. But I think the thing that I didn't take into consideration, some other folks didn't think about, was the amount of basically free for all spending that's going on by the federal government. When you are spending, when the federal government's spending deficit spending at a rate that's akin to World War II existential threat spending, 7-8% of GDP, that's going to negate a lot of the effects of the higher rates. And I think that's what happened. Um, I think that when I'm looking at the current situation in DC, I see no one there with the exception of maybe two or three people even talking about the out of control spending. I see both candidates have no intention. They're both MMTers. They're both going to spend money just on different things. And so I'm not sure how you have a recession in that environment. Now, I don't agree with all of this. I think it's foolish. I think that it will, it's like, eating McDonald's every day. Nothing's going to happen the first week, but down the line, it's going to be a problem at some point. So I think that's what's going on. I mean, if you give me $1 trillion to spend, I can show you a pretty good time too. So I think that's what's happening. Um, it's difficult to say. Like I said, certain sectors are, I think, gone through some inflation. I mean, if you're in a good sector, I mean, if you're in the construction business and you're building industrial facilities in Arizona for these ridiculous idea that we're going to bring chip manufacturing back to the U.S., you're doing well. If you're in some other industry, you may not be doing as well. So, and I think that the economy in the U.S., at least, and around the world, one of the things that several Austrian economists have always said is that when you have this Milton Friedman, Mises, some other folks, the danger when you create this type of situation where you just print money like we do, uh, and the Federal Reserve is basically running a Goss plan, Soviet style, manipulation of interest rates. You bifurcate society. Like Cantillon said, the closer you are to the printing press, the people that have assets, the people that benefit from this false inflation of asset prices that maybe isn't necessarily uh, entirely based on fundamentals, they benefit. So then you have the rest of the people, which is probably that's probably, 25, 30% of the population. If you're in a good industry, if you have assets, if you are close to the money printer, then you're going to benefit. And they have benefited. The St. Louis Fred has charts that show this. But if you're the rest of the people, working people, you're getting hosed, right? You've had a 25% increase in prices since the pandemic, and you haven't had wages going up. And people are like, well, what's happening? Why is my standard of living? Why do I feel like I'm not making any progress? And I think that's a large part of it. And I think those people do feel like they're in a recession, or they're on the knife's edge. They're barely making it. You see the different anecdotes where people, beating their head against the wall and like, I can't pay for this, and I have to make a choice between paying my car insurance and getting groceries. I mean, this is horrible. They don't own any assets, and the inflation that's created benefits asset prices, but it also people don't understand how inflation works. The prices go up, and you have shrinkage in products, but so what? You came down from 9% to 3%. You still have built-in loss of purchasing power of 30% for everybody. But if you're favored class, like people that are probably listening to this that have assets, I mean, I had some of the best couple years from the pandemic till now. I mean, so I don't agree with it. I think it's horrible. I think it's wrong, but this is the way, I'm not king, so I would change it, but this is the game. This is the cards we're dealt. We have to play them. So I think that's what's really going on. You have a bifurcation of society. And if you're in the right place and you actually understand what's going on, which the majority of people don't, then I've told people that have worked for me, younger people, Charlie Munger said it, you got to get a grub stake together. You got to be in this game. It's before it was just for wealth creation. Now it's going to be literally for survival. And I'm not trying to be hyperbolic here. What is going to happen in this country over the next 10 years, there is no way out. We have crossed the Rubicon. It's print or die. Now, there will be periods, I think, of deflationary or disinflations as they play around here with policy and interest rates, like we saw recently over the last couple of years. But if you look at the chart, if you go time travel 20 years into the future and look at a chart of these different asset classes, I think you're going to see, from this point and then going forward, starting at the lower left and going to the upper right. I mean, you have data from other countries that have went through this. I'm not suggesting we're going to be Argentina or Zimbabwe, but you don't want to live in a country where you have, if you're a wage earner, 5, 6, 7, 8% inflation every year, or periods where that happens and then they slam the brakes on, crash everything. You don't want to be that guy. You want to have assets so you can take advantage of the money printing and stay ahead of the bear, if you will. I was a little long-winded, but I hope I answered the question.
Yeah, I think you did to some degree. Do you think there's going to be a recession in the short term? Do you think we already went through it? Do you think
I think
this
it's
liquidity is going to save us?
Yeah, I think that, I don't think if we do have one, I don't think I think it'll be mild. Like I said, certain industries were already in recession, I think. But I think overall, I mean, what's a recession? If you get laid off, it's a recession. If your neighbor gets laid off, it's a recession. If you get laid off, it's a depression. So I guess it just depends on your perspective. But I don't think you're going to see a classic like we've seen in the past, where unemployment spikes. And I mean, I just think they can't allow it. I mean, the debts are so big. And I mean, people say, well, one of the things I was looking at really confusing was like, why did they cut 50 basis points? The economy is doing well, fairly well. I mean, you have nominal GDP growth of 5%. You have unemployment isn't really spiking. Yeah, the SAM rule, you have these arguments around the SAM rule. I don't want to get too in the weeds here, but I'm like, the reason they cut the rates is because can't afford the interest payments on the $35 trillion. The interest payments were $1 trillion a year and going straight up. And so, they know what they're doing. And I always suggested that they would do that. Okay, well, 3% or whatever, 2.8, that's good enough. Let's go ahead and get the next cycle going. So I think that, there may be you get into these where you transition from tightening to loosening, there could be a little bit of a dead wind time frame of 6 months to a year. I don't know. That's possible, but I don't think you're going to see a classic recession where unemployment goes to like 8% or something like that. Not with the kind of fiscal spending that's going on. I just don't see that likely.
I mean, that makes sense. That's kind of where I'm at too. Um, what has you confused about this market the most? What's got you offsides?
I mean, this thing's just so overvalued. It's unbelievable. And then, but I've seen this before in other market cycles. I lived through the tech bubble in the late 1990s, early 2000s. This is very similar type of justifications and, sitting there. I tell the story about they didn't have social media. All you had was like Yahoo message boards then. And I remember these ridiculous companies, they would measure the internet companies' valuations, not on sales or revenue or profits, on eyeballs looking at the website. So you had these ridiculous things like pets.com and drcoop.com. They had like billions of dollars valuation. So I was like, I got to short these things. And of course, I was getting killed. And you'd be on these Yahoo message boards arguing with people about valuation. It doesn't matter. It's a new era. You don't get it, blah, blah, blah. Okay, well, valuations do matter ultimately, but they haven't now. And if you, with the liquidity, things can go higher, right? You can see stock markets in, like if you looked in Venezuela or Zimbabwe, I mean, as money was printed, they went straight up. No, and the businesses were doing horrible because economic conditions in the country were horrible. But people, were going to try to buy something of value or something that was going up. So I think that's kind of what we're in. That's what has me confused. No one cares about valuations. No one cares about, we're in a new era. You don't get it. This is the US. We're dominating everything. I don't share that view. I sell overvaluation and buy undervaluation. And I'm a worldwide operator, and there's tremendous value in other places that are, things that I can buy with selling under book value, net asset value, paying me 7-8% dividends or more, and I'm content to buy those things because I know that these eras never last. They didn't last in the Nifty 50s. They didn't last in the tech bubble. They didn't last in the housing bubble. These, eventually, um, and maybe we're going to have a supernova blow off on this. This is what I think is probably going to end up happening over the next few years. We're going to have this supernova of asset price explosion. Like I said, like Cantillon says, you don't know what it's going to flow into. Is it going to go into copper? Is it going to go into gold? Is it going to go into stocks? Is it going to go into everything? So I think just getting that right and understanding that's probably what's going to happen, and then watching the markets, that's where I think some technical analysis can come into. If you're watching markets, okay, if something's basing and breaks out, then you can kind of jump on that, following what Druckenmiller said, that liquidity drives things. So I think that's kind of what I'm saddling up to do. Obviously, I'm partial to resource markets just because they're tangible and hard, and you can't, some bureaucracy can't just push a button and create more copper or more uranium or more gold.
Yeah. Do you think the pressures are going to first start in bond markets? Are we going to see interest rates really start to take off, and then eventually they'll save the bond market and kill the currency? Do you think something
Abs
like that's going to play out?
Absolutely. I mean, you saw what happened when they cut rates. Long bond went up. 10-year was,
Yep.
it's still going up. It's back over 4% now. What's going to end up happening? Here's what I suggest would happen. I mean, I don't know what's going to happen for sure, but I can tell you what other people that are smarter than me, or what historically has happened. It's very simple. What's going to happen? They're going to have to, like after World War II. Lynn Alden's talked about this a lot. After World War II, they basically ran yield curve control. You basically let the inflation rate, you hold long rates at a certain level, let's say 3.5% here in the US, and you let inflation run at 4 or 5%, and it just inflates away the debt slowly. You're stealing wealth from people. It's hard for people to understand how this works, what real interest rates mean. And what they'll do is very simple. The administrative state controls the laws. You have trillions of dollars in pension funds and 401ks and IRAs. It's nothing for them to pass a law and say, okay, after they implement the yield curve control, okay, here's another law. Because, they always have some tacky Soviet term, like it's a benefit for everybody. I don't know what they'll call it. Some law they'll pass that will say, okay, Fidelity, all the people that have 401ks, they have to put, some minimum amount of money, 10, 20% in a long-term government bond fund, whether they like it or not. We'll just pass a law, make the insurance companies do that. And they'll just do that because they control the regulation. Okay. And what are you going to do? Write a letter to your congressman? You're just going to get that wealth stolen from you if you're locked into that. So that's what has happened. And people say, well, that would never happen. It's happened in over 50 countries around the world over the last 30 years. It happens all the time. They know exactly what they're doing. They know the mess they're in. They know that this is all, the whole thing's politicized, and they get it. And so, I've seen Russell Napier's talked about this. He's laid it out many times. You got to listen to his presentations two or three times. He's very intellectual, but he lays out exactly how you would do this via yield curve control and the administrative state putting regulation. And like I said, because most people don't understand what inflation is, what money is, what real rates are, what nominal rates are, they'll have no clue. And they'll just wake up and say, gee, I had my money in here for 30 years. I didn't really do that well. What happened? And that's what they're counting on. Nobody teaches this stuff. It's boring and people don't like it. And it happens really at the margin and very slightly. So it's imperceptible to most people. So I think that's what the future is. I think higher taxes are in the future. They're just going to look for all kinds of revenue. You just saw it this last week in Denmark. Um, they were passing a law there for exit tax because people are going to haul ass once the wealthy people that know what's going on, they're going to start moving capital. So capital controls will come into place, all kinds of things to lock you in here and basically steal your money via inflation or your
And
wealth. And
maybe,
what you're really stealing is energy. You're stealing somebody's life, their time. You have this allotted amount of time and you're doing something. You're a wage earner, you're building a business, you have to transact in this currency that's controlled by this state apparatus that's full of psychopaths. And they basically, you're a slave to a certain extent. And people don't want to even talk. Oh, come on. Why do you got to talk like that? Because it's time to wake up. This is not the night. This is not the Eisenhower administration. This is not, the founding fathers. This is a bunch of political hacks that are trying to stay in power, run by an oligarchy that's strip mining the country. I mean, that's basically. I say this stuff, and people say, "Oh, you got to say it like that. We got to move the Overton window. That's what's going on here. You're not going to sit down with Entenmann's and coffee and figure this out with the other side because it's only one side up there. Therefore, the top 1%, and I'm no populist, okay? But this is what's happening. And if people don't get it, Cuppy talked about this migration of the 0.1%, okay? If you have wealth, for the average guy with $1,000 in a Fidelity account, this doesn't apply. But if you have some wealth, you got to start diversifying yourself and thinking about what could happen and contemplating what's the probability. It's not 0% that these things could happen, but there's some percentage. And then what's the timing? Because these things play out, it's not going to happen next week. They play out over time, So I think that, but that's the definite, like the trend we're on in the trajectory we're on. And I think people need to be aware of it, at least consider it in their allocation of capital.
yeah, speaking of all this, so they're looking to increase taxes, probably to get tax revenue wherever they can. They are taxing us through the currency of creating more currency and through inflation. How does one protect themselves against all that? I mean, you got to be looking at this from 50, 100 different angles because they might
Well,
start hitting accounts, they might start hitting 401ks, IRAs, all sorts of stuff from a tax perspective. How does one protect?
well, there's some people that, like I said, it depends what your level of wealth is and what your abilities are and what you want to do. I mean, not everybody wants to move to Costa Rica, right? So, I think if you are a high net worth person, you should probably already be doing this, but you should internationalize yourself. You should bank in one country, live in one country, do business in other countries. You should make yourself a worldwide citizen. You should have a bold hole somewhere, someplace you should travel. You should look around, say, this is someplace I may enjoy living, so I can watch what's going to happen on a big screen TV instead of being in the middle of, um, uh, this chaos that's going to, unfortunately, I think, play out over the next years here in the U.S. That's one thing. I think if you're just going to stay here, I mean, I think you can see what gold's been doing. Okay, you should study what gold is. It's money. It competes with dollars, yen, euros, all this stuff. People don't look at it that way. You got to think about, if they're going to inflate the currency, what has happened historically when people have done this, okay? When governments have chosen done this, and what has held purchasing power? What has allowed people to stay ahead of the curve? So I think you've got to be a certain proportion of your investments have to be in some hard assets. You have to move, prior to the financialization of the US economy over the last 40 years, if you will, since like the 80s, um, I read all these books about these famous investors or tycoons or guys that were in Asia, these taipans and stuff that came from Scotland and stuff and did all. It really intrigues me. And they don't talk about putting their money in stocks and bonds. It's all the history of wealth management throughout has been land, tangible things, land, gold, silver, whatever. And I think we're going to move back to that because what current, okay, people say, well, what about the dollar? What currency would you go into? None of them. Everybody's doing the same thing. So this is why I think you have to look at what has been considered money throughout history. I think Bitcoin's intriguing, but I wouldn't, what does an EMP over the U.S. do on, I don't know, or a solar, I'm a little bit hesitant, I guess maybe because I'm on the verge of a boomer, but I get the positives about it, but this is why I always come back to gold. Aristotle talked about what was money, and gold hits just about um, all of the criteria. And I think it's just you have to have a certain proportion of and you have to hold it. I mean, it doesn't mean go buy Perth Mint certificates or the ETF. You have to accumulate physical gold, or some people say, they'll get these pre-1965 dimes or quarters or whatever. I mean, there's different ways to do this. And any budget can do this, any budget level. I mean, right now I'm kind of loaded up with gold that I need. I don't keep the stuff at my house, so in case anybody thinks kicking my door in, I keep everything in a private vault. But I've been accumulating platinum. I mean, it's relatively cheap. It's a precious metal. It's 17 times more scarce than gold, and it's selling for 75% discount to gold right now. So I think they sell 10th ounce coins. I mean, people can, if you have a budget, you can just get on accumulation and start thinking about this. But I think before you do it, you really have to have an understanding, I think, and kind of understand what is money and what's happening. And if you're a high net worth, you've got to get some of your assets out of the US. You can't, when they close this thing down again, we get into a currency crisis or something like that, that will not be the time to be like flying over somewhere and trying to figure out how to open a bank account somewhere. The time to do that is now. So, but that's not for everybody. People are tied to the U.S. They have family ties and stuff like that. And but there's more and more people that you see even internally in the U.S. People are leaving these ridiculous statist policies in some of these blue states. But you're going to not to get too far off the track here. This is the trend for the entire United States. There's going to be nowhere to run eventually, and then just going to keep twisting because they need money and they're going to get it. They're going to even propose, Andy, a tax on unrealized gains shows the economic illiteracy you're doing. Do I think it would actually get through Congress? No, but to even be talking about that is scary enough. Okay. And if you get a certain amount of populism on the left populist morons elected, you see what they do in some of these other countries. They more and more ridiculous. And then what they do is they cause the problem and then they band-aid another ridiculous solution. So you have, 18 band-aids on top of a sore that was originally caused by bad policy. So that's what I think is going to happen. I think there's a window of opportunity. I trade things all over the world. You can get on a plane and go to many countries. You can be there within 24 hours all over the world. There's opportunity everywhere. You can move money around still. It's not impossible, but it takes a little bit of work. And I would suggest people consider that.
Okay.
I'm not trying to be hyperbolic. I mean, it's going to play out over years, I think, because there's a lot of ruin in a country, as Adam Smith said, but isn't it obvious what the trajectory is here? I don't know. To me, it is.
No, yeah, no, it's obvious to me too. I just look at I'm most afraid of the currency really taking it here. And so I'm positioned for the currency to lose its value. I mean, that's the way that I'm positioned. Here's another question that some people, they'll make this statement. I want to see what your opinion is on this statement. It says, I've got a lot of people point to the stock market going higher and then say the economy is strong, what is your view on that statement that people make that correlation?
Sometimes that's correct, and many times it's not correct. You can go, like I said, they should go look at a chart of the Venezuelan stock market, it trades, or in the Zimbabwe stock market, and then look at the news reports. You can go back and look at the history of how the economy was doing. It's about money. I mean, you can look at Weimar Germany. There's a book that everybody should read. It's called When Money Dies. It's about the Weimar hyperinflation. It's not a textbook. It's written from the perspective of different vignettes of people that went through it and their experiences, their letters, their diaries. Of course, it's kind of a narrated thing by the author, but this was one of the most sophisticated intellectual countries in the world, and it went through a hyperinflation and destroyed the currency. A lot of the animosity to, and another reason why National Socialism rose there was because people had a lot of animosity to the surrounding countries. People would come into Germany during the hyperinflation and buy people stuff for 1 cent on the dollar because they were desperate to sell it. And they had hard currency, whether it's French francs or Swiss francs or whatever. There was a lot of animosity building in Europe against other Europeans that could come in and take advantage. I saw the story that it was possible during it didn't happen, but it would have been possible if it was for sale. The real estate was so cheap in downtown or in the center of Berlin, in the central business district, that just, a small amount of gold. I mean, that was the value. You see what I'm saying? The currency had inflated away so bad. And people should read this because it's, like I said, it's from I remember the story in there where there was a very wealthy widow of some lower nobility, and her financial advisor saw what was going to happen. They had financial advisors back in the early 1900s too, and he said, get your wealth out of these insurance policies and some of these other things your husband left you and move it into Switzerland because we're getting ready to have a hyperinflation here. She didn't listen, and the whole thing, her whole substantial amount of wealth that was willed to her by her husband. I mean, it's in that book. It talks about that. That's going to happen here because people don't understand what's going to happen. And these currency crises, they can happen very quickly. All of a sudden, you wake up one day, everything's fine. And because people have recency bias, then all of a sudden this thing starts to go. And, what happens if okay, you have a bond market failure, let's say. They can't sell all the treasuries, okay? Because none of these foreigners are buying, not only because it's a bad bet for long-term bonds, but also because of our geopolitical stumbles, the stupidity of the United States, some of the stuff they're doing. And so you're going to be like Japan. You're just going to have like the Federal Reserve owning 90% of the treasury market. I mean, what's the dollar look like in that scenario? I don't know. It's not at 100 on the Dixie like it is today. That's probably at, 70 or 65 or lower. Who knows, right? And then there's no way you can stop it now. What do we all, somebody actually, made this statement the other day. If you did, Javier Milei did this in Argentina. He got rid of all deficit spending last year. And he did. They have a surplus now. And they have 50% of the people in the country living in poverty now. That would not be politically acceptable in the US. So we're not going to stop deficit spending. We're going to keep doing what we're doing. I mean, I've heard Felix Zulauf say this a couple of years ago. He says that he can foresee the Fed's balance sheet by the end of this decade being 30 or 40 trillion dollars. Why not? They're going to have to monetize they're going to have to be the buyer of last resort. And then, like you said earlier, that results in one thing. It's not like people don't ask the question, well, if the Fed's buying these bonds, where are they getting the money? Well, they're just creating it out of thin air. Yeah. And people don't understand how the mechanism, like when they lower rates, they don't just like issue a memo to all the banks. The New York Fed trading desk starts buying bonds, okay, to push rates down, okay? Where do they get the money to do that? Well, they create it. So that's the Cantillon effect. Then where's that liquidity? If I sell my bonds because I know rates are going down, I'm trying to get out of my, then because if I'm holding, how, and most people know, I hope, the difference between bond prices and interest rates, that they're diametrically opposed. But, so you get $10 million because you sold your bonds to the New York Fed. What are you going to do with it? You're going to put it in the stock market? You're going to go into real estate? This is how these things, money gets transmitted into the economy. People say there's no inflation the last decade. Yes, there was in asset prices. There was tremendous inflation in asset prices. It just didn't, trickle all the way in. It did, once they started sending checks to people. So I kind of got off track here a little bit, but I forgot the question. But anyways, I'll stop there. But it's so obvious what's happening, and I think people really need to educate themselves. And you can't just do this, because what will happen if you don't really have a view and you haven't educated yourself, you'll just be like, okay, I bought some gold because I heard this guy on the internet say that this was, a good thing, and then it doesn't really do anything for a year or two, and then you're like treating it as an investment instead of a part of a plan to preserve your wealth and not allow them to steal your life force away from you. So anyway,
Yeah, so going forward, so we kind of got the problem. The problem is the current situation that we're in. We've got a lot of money printing, debt is a problem, fiscal spending through the roof. How do we play this? Like, what would be a good strategy to play what is coming? So when I think of strategies, and I'll just kind of say one strategy that I have is get inflation sensitive assets that produce dividend income to me. So I can basically increase my income as inflation comes. So that's one way I can protect myself if my costs continue to go up. What are some strategies that you kind of look at to mitigate against what you think the problem or what is coming in the future?
so that's exactly what I do. I mean, I have a portfolio separate from, I have my actionable intelligence and portfolio, but I also have this dividend portfolio that I created. And it's not like, it's kind of like a dividend aristocrats, but based on tangibles. So there's companies in there that are in these businesses, and they're not like rinky-dink companies. I'm talking about very large, well-recognized companies that have the ability to increase their cash flow, take advantage of these situations. I'll just throw one company there. I like a company like Glencore. Okay, it's going to take massive. They're experts at this, what they do. Okay, and it's like there's still vestiges of Mark Rich there. That's what I like about it. I mean, they stole basically Tech Resources coal assets from. And then they had a shareholder referendum recently where they said, "Do you want us to get out of the coal business?" And all the shareholders were like, "Absolutely not. Buy more coal assets." So I think that's one way to do it. I think, looking at some foreign situations that are undervalued, that are maybe resource intensive countries. I like that. I've said it many times. I'm very bullish on certain places in Latin America, some of the Central Asian republics. I like the Republic of Georgia. I like to focus on energy because I think energy is going to be scarce going forward. People just seem to think they have an abundance mentality, but when you start putting math to these populations in the global south and east that continue to increase, I think you could stay ahead there. In inflations, energy actually performs the best, not necessarily gold. So I think you have to be in energy and be thinking about energy. And there's different ways to play that, like we just mentioned. I think what a lot of guys do or people do is, especially on these YouTube circuit of talkers and the guys that listen, there's nothing wrong with putting together a good, I mean, I just throw out one name. You can buy a company like Eco Petrol. It pays a 32% dividend right now. Yes, it's in Colombia. Yes, the president of Colombia, last name is Petro. He's a socialist, but the Congress there is not socialist. So he can't implement what he wants to do. So, they just found with Petrobras offshore Colombia gas reserves that are equivalent to the current reserves of the entire country. So there's opportunity out there. You don't just buy 100% of that, but you can layer on things like this. And they're, another good company, like I like Total Energy. They get it. They're an integrated oil producer. They're the French national oil company. And they have doing a spoke and wheel thing. They have renewables, they have oil and gas, they do frontier exploration, and then they do energy trading all in the middle and arbitrage all of this. They're like on the front end of figuring this out. And, they're going to do, they're doing $10 billion a year in free cash flow. 8 billion of that's going back into share buybacks and then dividend increases. That's the kind of companies I look for to stay ahead of this kind of curve. What most people do is, hey, what's the junior up in Canada I can buy on the venture exchange that's going to go up 10 times in the next 2 years? There's a place for some speculations, but to protect wealth and build it and stay ahead of this, I think framing it in that perspective, that's one thing. I think some physical metal in your possession. I think gold mining the gold mining stocks are tremendously undervalued relative to the gold price. They're going to move eventually. We're starting to see some EKG blips there. So I think that's an area. But again, you have to be selective in these things because, a lot of these companies are together. I think I put a chart up last week. Somebody had it on Twitter. If you took and created like all of the companies on the TSX that are in mining and called it like Canadian Mining Company, it's a net destroyer of capital. So as like everything else, you have to be selective and really know what you're doing. And then I think if you're going to be in these resource sectors, you should really understand if you're interested in copper, you should understand the cyclicality of copper and what drives that, because these are all cyclical things that move independently. People say, well, I'll just buy an ETF. Well, why would you do that? Because agriculture is underperforming right now. So you'd be dragged. You have to really understand each market's, at least have an inkling of the cyclicality. But I think you have to do, as long as you do something, you'll be fine. Because I think the liquidity, the amount of currency units are going to be created are kind of going to be like a hurricane coming in and just lifting everything to a certain extent. So that's kind of what I do. I think you got to be somebody that I've really become a big fan of, and people should read his stuff, is a gentleman named Murray Stahl at Horizon Kinetics. He's got this down. He understands. They've basically run their whole shop towards this idea of tangible assets. Kopernik down in Tampa, run by Dave Ibens, another guy that gets it. His shop gets it, and they have tons of reading material about their philosophy around tangibles and what's happening. I that's where I got the idea of the Cantillon effect from Dave Iben. Then I read it more about it, and I said, this guy, get as close to that money printer go burr as possible. So, and what's, like you said, what is going to be affected by that increase in currency units? So I think that's the right way to go. There's different ways to do it, as you said, but I wouldn't just. I think to optimize it and really tune it up, you really have to be selective and not just think, well, I'll just buy a couple ETFs and call it good. You could probably do okay, but you can do better by putting a little work in.
Yeah, I think, well, what I've witnessed and noticed with a lot of retail investors, and you brought it up too, the junior mining stocks and these guys that are real small, they're exploring, maybe they're developing mines or whatever, but they're not cash flow positive, they're not cash rich companies. What's the problem with investing with those, in your opinion, if
Well,
there is any problems?
I think there is a problem for the average retail investor. You're way out of your element. And I've told people this before. If you're gonna play around, like, so this doesn't apply to the guy that's jerking around with a couple grand in a Fidelity account. I'm talking about if you have real wealth, if you have some money, your goal is to compound that wealth consistently over time. And I think that if you become enticed into the junior miners, you should go to one of these shows, like in Vancouver that they put on, or Toronto or whatever, and walk the hall of all of the presenters of all of these different mining companies. And you can talk to, they'll give you all the information you want, slick brochures. They have IR people there who will tell you why this piece of moose pasture is the best. And they have an answer for every one of your questions. Um, I don't think you can do that. You can't afford to fall behind on what's going to happen, because it's going to be a matter, I think, of literal survival. So I think unless you are really devoting, unless you're like a John Duty type guy or one of these guys that just does junior mining, Rick Rule or something, um, what Rick Rule and them don't tell you is that they don't buy stocks on the exchange. Okay. These people are plugged in. Rick Rule's been plugged in since he has brokerage firm in San Diego 50 years ago. Okay. These guys are at the table. They get preferential treatment on initial stock
Warrants.
offerings. Yeah, okay. And they get warrants, and they have the company by the short hairs when they're giving them money. They know the people, they know who the players are. They get a warrant, they immediately sell the stock and hold the warrant, rinse and repeat. And you're not going to sit at that table unless you're an accredited investor, number one, and you know these people. If you don't know Marin Katusa personally, if you don't know Rick Rule personally, if you don't know some of these other people, those are the big names, you're never even going to get any of that stock. Okay. So that's how the real money is made in junior mining. Okay. Not buying junior mining stocks and hoping that the drill results on drill hole RS-13, you know, the best way to take advantage of this is to buy established companies that you listen to the managements, they get it, they know how to increase cash flow, they're professional at what they do. I'm talking about Glencore, Rio Tinto, BHP, Lundin Mining, okay? These kind of people that know what's going on. Yes, you can dabble in some of these other things, but it's like I've told people like in the uranium market, why are you screwing around with all these juniors? You have a rising uranium price that's going to rise continuously, probably for the next 5 to 10 years. You want to be in companies that are generating cash and taking advantage of that, able to increase production in a rising. That's how you're going to make, decent money. Yes, you can play around with some juniors here and there, but I mean, I've seen people with portfolios that screwed around with this, and then you look at their portfolio and you have these fossilized companies and they're down 90%. It's like, why do you own that? They don't even know why they own it. It went down 90%. They don't even want to look at it because they get a six. They should just stay clear of that because you can't afford to, if you get a 90% loss on something, you need 1,000% return just to get back to even. And 90% returns in junior mining happen every week. We had a 50% decline over the last 4 months in uranium, and everybody was ready to commit an uranium stock price. Some of them commit ritual seppuku, and nothing changed fundamentals except it got better. This happens in junior mining. So you got to understand the game that you're in and what you're doing. And if you don't understand that, number one, going in, you're just gonna not do well. So, and I don't think they don't have the knowledge. People don't know anything about geology. I don't know anything about it. And so, you can learn a little bit, you can expand your knowledge base, but what's the return on investment in doing that instead of just saying, okay, if you're a general investor that has a life, a retail investor, I get just getting the general trend right is good enough. And then, how can I set myself up for success there instead of screwing around with junior mining companies with no sales and earnings or prospects. One in 3,000 prospects becomes a mine. I mean, those are not good odds.
I look on Twitter and I read through some of these guys' portfolios because they post their entire portfolio, and they're 100% junior companies, and I'm like, oh my goodness, you're taking on copious amounts of risk, and your probability of success is very low, and it's just that's not my strategy. My strategy would be a little bit, well, not a little bit. It's way different than that. And it all deals with portfolio allocation, how you position size, and the juniors. It's just you shrink that position size up because the risk and the probability of success is so out there. So I just wanted to make sure we touched on that because a lot of people they watch these YouTubes, they try to glean as much information from everyone, and they try to put that into a strategy. And their strategy is let's go buy a bunch of high risk, low probability success companies and be dissatisfied with the outcome. So yeah, that strategy wise, I just wanted to touch on that. Opportunities right now, looking at everything that's out there. You said emerging markets. You said, some of these areas that might be outside of the United States. Are you looking at potential currency differentials there where their currencies could go up and ours go down? That's generally when they really thrive historically, because that's what I look at. And then what I try to do is I try to get a bunch of dividends from those areas, because if our currency goes down and you just said Ecopetrol was paying a 30% dividend yield, and there's other countries that pay, I'll just say, very lucrative dividends. I can net the currency exchange coming back to my currency. Is that something that you're playing too, or that's on your mind with the emerging markets maybe outperforming?
Yeah, I mean, because all of these things are interdependent, right? So emerging
Mhm.
markets weren't doing well because rates in the U.S. were very high. These things go in cycles. You can go and look at us, bring up the MSCI or bring up for the emerging markets, and then juxtapose it against the US. These things kind of stay out of phase and they go in like 10-year cycles, right? So right now, if you look at emerging markets, I'm just using emerging markets as a general term. You got to focus in on certain countries, and there's companies that in each of these markets. I mean, there's a Van Eck product that has a high dividend yield, emerging market high dividend yield. It pays like 8.5%. You can buy stuff like that, but I think with the U.S. the dollar is going to be under pressure, and I think that allows, like you said, these other. It's all interdependent. I mean, if both countries are cutting rates at the same time, likely there won't be too much of a currency differential. But if they stop and you have to understand these things. But that's exactly how you laid it out is my thinking on this. Exactly. In some of these countries, I mean, I'm not talking about you don't have to go wild. I mean, there's tremendous values in Hong Kong and Singapore. These are legitimate places. Now, I wouldn't go into mainland China right now. I mean, I talked about China being tremendously undervalued over a year ago, but I can't invest. And you saw what happened just in the last month. I mean, Alibaba and some of these things are up 50%, but I can't buy these companies because, when the United States has a policy that they want to have a war with China by 2027, they've already started the escalation ladder with them. I already learned my lesson in Russia. I made a lot of money in Russia. And then all of a sudden, the United States government decided to come along and say that I couldn't own stocks in Russia anymore. And I lost a lot of money. And I didn't appreciate that. They didn't have the right to do that. And we can argue about the merits of using but that's going to, just as a side note, that's going to be one of the worst decisions when the history is written of the demise of the United States was kicking a major country out of the SWIFT system that sent a tremendous message to the rest of the world. It's just totally undercut the dollar. It may have been the final nail in the coffin, but that's a side discussion. So, China was a tremendous value, but I couldn't go there. I made it very clear in my podcast and in my newsletter. If you go all in on China, it's tremendously undervalued. They're probably going to come in with a liquidity move. That's what they did to a certain extent, a bazooka. The thing's up big. If you beat me this year in performance and you beat me, I'll take the loss. But I just couldn't go there. So, but I think there's plenty of other areas. And then you have to look in individual countries, and then a lot of these companies you can buy trade like in the U.S. as ADRs and stuff. So it's not like you're locked out or you have to fly. How do I go there and create a brokerage account? You don't necessarily have to do that. So there's all different ways to play this. I mean, there's an emerging market bond fund that I've had for about a year. It's outperformed greatly because all these countries are cutting rates, and so now that the US is cutting rates, it really popped. So um, understanding, like you said, kind of that intermarket relationships. It's not just everything's not just operating in a vacuum. The currencies, rates, all this stuff kind of plays together.
Yeah, I'd like your opinion on this too. Another thing that I see with a lot of retail investors is they try to time the market to some degree. So what they do is they put all their money in one sector. So they'll say the thesis of uranium is fantastic. I put all my money in uranium. Or we have a potential recession coming. The yield curve is dropping. I'm going to put all my money in precious metals sector. Is that something that you do? Are you trying to time this stuff, or do you kind of spread out? And what are the reasons for spreading out for doing that strategy?
No, I don't. I don't do that. What I do is I position size. I put a lot of thought into everything that I do. I keep a log. I write down why I get involved in these things. And one of the things you're trying to do when we're trying to compound wealth is mitigate risk. And one of the ways to mitigate risk, as you well know, is portfolio allocation. Okay. Inevitably, at the end of this bull, let's just use uranium as an example. At the end of this bull market, because I think uranium's going to go a lot higher, and eventually the stocks are going to enter a bubble phase. There's going to be some article in USA in the Mick paper, USA Today, about some idiot. He's going to be sitting in front of a laptop in his mom's basement with a grin on his face. This guy turned $1,000 into $50 million in the uranium bull market. That'll be the top, right? And because he went all in. There'll be those people, but you're not going to that. There's lottery winners every Powerball drawing too. You're not going to win the Powerball more than likely. So I think again, what am I trying to do? I tell people this that I want to get into investing. They write me, DM me. First thing you need to do is go to the Berkshire Hathaway annual report for the last year and open the first page. It has the entire returns for the partnership and Berkshire Hathaway going back to the 60s, whenever they converted from the partnership to the corporation. And you look at the total returns, all the ups and downs, The net has shows net asset value increase and total return, basically 20% through all a year through all the years for the acknowledged as one of the best investors in the world. You look at Lynch, all these guys, Howard Marks, they're all in that Druckenmiller, they're all in that same range, somewhere between, Walter Schloss, 15 to 20 something percent a year, okay, long term. They're the super investors. Those are your major league players, okay? What kind of a person is not self-introspective enough that thinks he's going to do better than that? Okay. First of all, you have to understand what we're trying to do here. The best thing, I hate to say this, I'm just going to say it. The best thing to do for the average person listening to this is not buy my newsletter, not watch YouTube videos. Go find the cheapest Vanguard world stock fund that you can find that allocates based on the world. Put your money into that every month and don't look at it for 40 years and you'll probably do okay. Okay. That's what most people should do because they don't have the temperament. They don't have the knowledge. They don't know what they're doing. Okay. Now reality. Everybody listening to this is not going to do that. And so the goal is to compound wealth, beat the returns. You probably get 8 or 9% in something like that. Okay. Dividends reinvested. So the goal as an active investor is, well, I'm going to be active because I think I can do better than that. But the problem is because you get into these bubbles that we've seen, rolling bubbles in crypto and the stock market and all these things, people, if I'm walking down the street, they used to have $10,000 bills back in the day. So I'm walking down the street and find a $10,000 bill in the gutter and I pick it up. Does that make me a good investor? No, it means I was lucky. And so I think people get confused on, first of all, setting expectations correctly of what's possible. Number two, overestimating Dunning-Kruger, overestimating their ability, and then not really writing down what they're trying to accomplish. I want to be rich. Okay, what's that mean? Is the stock market the appropriate vehicle for that? It's a tremendous compounding machine if it's used correctly. It's just like anything else. If I pour gasoline on a brush fire and half of it on me and then light a match, I'm going to go up in flames with the brush pile. I mean, this is what people do. And I'm not trying to bag on people. I'm just, I get so many DMs and emails and same thing. It's here's my portfolio. Why are you in all these? Are you like a mining engineer? Do you know about it? No, but I heard, aren't these good? Gold's going up. Brother, please, listen to what you're doing here. And so I think understanding what you're trying to accomplish. The main thing I want to get across to a lot of folks is also if you're young, I mean, I'm 57. It took me a while to learn this through hard knocks, okay? But I've still done well in spite of that. If you're young, you have the most important, valuable asset. You have time. If you understand compounding, if you understand how wealth's created, you just get rich quick. And as Charlie Munger said, the problem with most people is they just want to get rich quick. That's it. And that's what leads them down some of these paths. And that's just not how to get rich. If you look at a compounding calculator, or if you do the math yourself, take a penny and double it every day for a month. Okay, for the first couple of weeks, you don't have anything. Okay, 1 cent, 2 cent, 4 cent, 8 cent. Okay, in week 2, I'm to $20. It's in the final part of the compounding of the time where things go exponential. But if you don't, you can't harvest, nuts or oranges from a tree that you just planted this year. It takes time to let it mature and grow. And I think people miss out on that. And that would be the thing I try to impress upon people. You're not going to be a major league ball player like Stan Druckenmiller or Warren Buffett. You just don't have the intellect, the time, the resources they have. You don't have the emotional makeup. And so that doesn't mean you still can't have a successful investing career and create wealth, but you got to, it's not going to be easy and they get rich quick. And because that's part of why I hate the Federal Reserve and the state and the statist mentality, because they create these bubbles and then people have these skewed expectations. I just need to catch a bubble. Give me a stock that's going to double this year. It's not how things work. Eventually, if you set yourself up correctly, you can run into situations. I've had stocks that have went up, 5 and 10 times. But I didn't, that was kind of like a bonus. That was extra icing on the cake from an already, decent situation in a long holding period. So I think, I think that's what people need to, those are like rapid fire answers. But I think if you take that cumulatively, You really have to sit down and think about who am I? What risk can I take? What am I trying to accomplish? What have successful investors that are major leaguers? How do they do it? They put all their information out. You can sit here for 12 hours a day and read letters and going back decades for all these famous investors. They're all basically the same. Buy undervaluation, sell overvaluation, let it compound long term. That's basically the trick here. There's
Yeah,
no other way to do it.
the thing that I would say, in order to get really rich really fast with not a lot of money, requires insane concentration with leverage, and then your risk is through the roof. And then what people do, because they don't know when to stop, is if they do win, they go until they lose. It's just like gambling. And
Did
that's
you
where
see
I'm
the
like,
Yeah.
I
Did you
don't
see the
I don't want to
did
lose.
you see the article about the guy that's suing his fiduciaries? He
Yep.
ran up like literally like 10 grand into 417 million in Tesla stock. That's
Just
basically what he
options.
did.
Yep.
Yeah.
Yep.
Yeah. And then I was JP Morgan or one of the big firms was like, hey, wait a minute, this guy's a whale now. They introduced him to all this, tax attorneys and all this stuff, and he didn't follow any of the advice, evidently. I don't know the cue. Basically, how do you lose $417 million, Andy? When is enough enough? And that's an extreme example. It can be done. The guy got lucky. He rode the wave. But then,
Yep.
once you got to 100 million, was that not enough? Then and he gave it all back. You can't do that because it's hard to catch back up and you've lost that time then.
Yeah, concentration, risk, leverage, a lot of these people end in ruin, and that's the gambling mindset. Jesse Livermore, the best trader in the world, he went rich and broke. I think it was 3 or 4 times throughout his life. And you don't really see that with the value investors. The value investors just plop every single year, going up and up and up. And I don't think they take on that gambling mentality. And I just wanted to talk about it real quick because
No,
it's a
I
strategy that
agree.
I think a lot of people are adopting. And I'm just like, you guys, time out. You are taking insane amounts of risk. And a lot of the times, what you focus on is the few percent where it worked, and everyone else, the 90 something percent, lost. And that will always occur. That will always be an outcome just based off statistics. You'll always have some people that luckily won, and then everyone else loses. That's the way it is. So how can you replicate a consistent win over and over and over and over? And that's where you compound and win without getting these huge losses. You're not gambling, so to speak. And I just see a lot of gambling mindsets, even on Twitter. It's like a whole bunch of gambling mindsets, and I'm like, time out, guys. You're going to get smoked. But I think that's also a function of the times that we're in. It's hard to accumulate capital because of how expensive everything is. So they almost have to take on the gambling mindset in order to catch back up to maybe people that already have assets. So it's understandable the emotional mindset that maybe they've acquired here.
Yeah, I think
I'm thinking
two
back.
two thoughts. I mean, just to finish on that Jesse Livermore thought, he ended up shooting himself or jumping off a building. I can't remember. He committed suicide.
Mhm.
Um, and then the other thing I would say is, like Munger says, to avoid that, he used 100,000. It's probably a little bit higher now. He used to say this. You got to get that first 100,000. This is his words. It's a bitch, but you got to do it. If you got to eat bologna sandwiches and walk everywhere, you've got to do it because once you get that, he says then you're not under as much pressure and you can take your foot off the gas a little bit because I think that's what happens. And I think another thing that's interesting that you'll see in When Money Dies and some other things I've read, when you get into these situations where the central bank is doing what it's doing, debasing the currency, and people are feeling stressed, they start to get into it. You'll see even regular gambling increase because people are trying to get rich quick. They're trying to stay ahead, they're trying to get a quick hit, and then that'll solve their problems. And I think that, I try to counsel people, if you have a job, if you're working, I've had guys that work for me that are just on tools and stuff and they're, barely make it. So even if it's $20 a month, dude, you got to start somewhere because it starts building on itself. You can't just, with the changes, the seismic changes that are going to happen over the next couple decades, it's not going to be positive for most people with AI, robotics, um, with what's going to happen with the fiscal situation in the United States politically and socioeconomically. It's not going to be this place is a dump. It's an empire in decline, and you're going to be swimming upstream against a lot of stuff. So you gotta kind of understand what's going on, and you got to be in the game. You got to be in that top. What are the top 10, 5, 1%? People always say that we have to tax the rich. We're going to do this. They control the system. Taxes will not be raised on them. They're not going to do these things. I mean, people don't understand how the system works. And I guess, going back to a conversation we had earlier about something else, it's like once you realize it's not like you think it was in fifth grade social studies, then, you get to make a choice. You could be like Neo. You have to take the red pill or the, I don't know, whatever pill, you know what I'm saying? Then you have to go one way or the other. You're at a fork in the road. You can't just sit there and, stay asleep. So anyway, I think a lot of it comes down to psychology and emotions and the individual makeup of each person. And then again, what they're trying to accomplish in the circumstances. And there's going to be guys in here right now that are scoffing and saying, these guys don't know what they're talking about. I'm going to roll. Okay. Well, I hope it works out. I'll be with you. I hope it works. But like you said, we won't hear about, I remember distinctly one more vignette. I knew it was the top in the tech bubble because CNBC was on. And this is when we dial up just, I think it was like 56K was the internet. So you just had like, you couldn't even get updated quotes and stuff. But anyways, I was sitting there watching it and off to the side, and then they brought Surge the Trader on. It was this dipshit guy who's like late 20s. He was sitting at a bar. He had a martini in front of him and a big cigar when you could still smoke inside. And they asked him, he was being all arrogant, all the money he made. That's what they called him on the bottom. It was in parentheses, Surge the Trader. They were going to ask him his opinions on the market. And I'm like, look at this putz. And I remember what he said. He takes a big pull on the cigar and blew the smoke in the camera. This is the first time in the history of the world that people my age have had this kind of wealth. And you better get used to it. I never saw him ever again. It was like, that was the top. I mean, if that wasn't the top, I know he probably went back to his job waiting tables at Chili's. I don't know what happened to him, but if he's watching, I'd like to reach out because I kind of know. But, that's the mentality right there. That's what happens. Or remember during Bitcoin when it ran the first time, I made money on it. I played it because it was running. I played around with it, but then everybody was like, some of these cats were all in, and it's like not gonna make NGMI or yeah or whatever, right? Not gonna make it or whatever they would say. It's like, okay, boomer, you're not gonna make it. Okay, dude. Well, this is a bubble like all other bubbles, and it's gonna end the same way. And so I think it's fine to play bubbles. It's fine, but you got to know what you're doing. And if you're just, going all in, like I said, I hope you're that 1 or 2% that it works out for.
Yeah, here's a quote. I'll just read this quote real quick. This is from Walter Schloss. He says, "You must have the discipline and temperament to resist your impulses. Human beings have precisely the wrong instincts when it comes to the markets." And I just see it, I'll just say retail investors going all in a particular sector, generally junior stocks, and they have all of the wrong instincts because they're brand new to investing. And I'm like, that's not a good mix to have all that together. So, and then Peter Lynch says it's crucial to be able to resist your human nature, which
Exactly.
is completely true. So none of these people that are coming into these markets naturally have the right instincts. I didn't either. I didn't have the right instincts when I first started. So it's a learned trait. And all I'm going to say to most people is roll in slow, learn it first, then go in big. Or find a mentor and find someone that you can latch onto to learn from. Because I don't know how to go back and relearn all that. It took me many years to figure that out. So
I was in the same
same.
boat. I mean, I wasted a lot of time, and then I finally figured out, like in anything else that I would do in life. I mean, at the time I was working in the utility, and we had SME, subject matter experts. So if I had a question about a steam turbine, we had a guy that just sits in a cubicle all day and knows everything about steam turbines. You call this guy up, he's about 60 years old. you got to get your cup of coffee ready because you're going to be on the phone for 2 hours as he spins yarns about, war stories, but you're going to get your answer because he's an expert. And so I think I realized, I said, that probably applies to investing. And that's what leads you down the road of identifying who all these successful people are. And you're going to start noticing when you start reading about a half dozen of them, you're starting to see the same advice, the same traits. It's not that, and so I think then training yourself that way is helpful because otherwise you're just going to spin your wheels. You're going to have some good years. You'll have some things that work out, and you'll think, okay, I know what I'm doing, and then you're gonna, but you're not going to be consistent. That's what's going to end up happening. You're just going to be treading water, or worse, even worse, just losing a bunch of money and becoming discouraged and swearing it all off. So yeah, I agree.
I don't have any other questions. Any other statements that you'd like to make? And how can people follow you, reach out to you, and all that stuff?
Well, one thing I just wanted to ask you, I think if I remember correctly, last time we talked, I have been I was going to ask you, do you use technical analysis at all? I do use it to a certain extent, like especially in a market that's basing. That's one of the things I took away from one of the super investors was they didn't use it to forecast, but they would look at it for like when something's going to break out. Paul Tudor Jones, that's what he uses it for. Like markets that have based for a long time, and then I would like track, and then I could see like apply some like what we saw in gold. I mean, you saw a classic multi-year cup and handle. Okay. I mean, so obviously like textbook breakout from a cup and handle, and those are usually powerful trends. So, do you use any kind of technical analysis, or do you just think it's crayons on paper, or do you think it has some use?
So I use three pillars to my approach or my strategy. It is technical analysis is one of them, market conditions, which is cycles, and then the third one is ratios because it's an objective way to look at something and say, is this cheap or expensive compared to history? So if something's cheap and it has good technicals and the cycle's coming where it's coming into favor, I'm like, boom, boom, boom. I'm going to start looking on the prowl. So I actually use technical analysis as an unbiased approach to see what the markets are thinking about a particular sector or about a particular area or even the macro. So I look at like 10 or 15 different sectors, do technical analysis on all of it from a bigger, longer term perspective and say, yep, good, 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 good. And you might have to use technical analysis on ratios too, which says, we're at a really cheap area, but does it look like it's ready to come out of a base and turn? Is it broken a downtrend? Like just simple stuff. In the short term, I think technical analysis will get you into trouble. On the longer term, I think it works very well because you're charting the fundamentals.
Hmm.
The short term is all emotional driven. It's not something that I would use. So, what I have found to be the most successful at, I'll say, the most success at not necessarily timing the market perfectly, but getting in the general ballpark area, getting the right sectors that are cheap, and then identifying companies too. I think technical analysis is a gigantic help. And then you want to backtrack the fundamentals. So I start at the technicals, I then look at the fundamentals, and they got to match. If they don't match, chuck it. I self identify as a hybrid investor between technical analysis and fundamental analysis. I don't think you can do one or the other and be as successful. I think pairing them together will make you far more successful than choosing one or the other camp. So I think it's absolutely necessary to add them together. And it will prevent you from choosing crappy companies because if you look at the fundamentals, you're like, nope, this doesn't have the fundamentals. I don't want to be in this company, even though the technicals might look good in the short term. So the technicals are good for a starting entry point where it's bottoming, and then the fundamentals will carry you forward of the sector and of the company. And what you want to look at it, the way that I look at it, is you want to look at, what's the growth of this production? Are they high cost or low cost producer? What is their sensitivity to the commodity price? That commodity price better be low and be improving if you're going into a high cost, high debt company, because that's a lot of risk. But that also can give you where all the returns are at. Because if you go into high debt and you go into something that is a higher cost producer, they're going to sell the pennies on the dollar on the downswing. And then when you get to the upswing, you're going to absolutely make 20, 30, 40, 50, maybe even multiple hundreds times your money if they can rapidly grow production and they are high cost. Because on that downswing, they're going to literally sell off 99%. and
Yeah.
it's the debt that's causing that sell off. It's not, it's not a low risk play. But if you position size appropriately and you don't take all the risk in the world and you catch this thing off a bottom, and you can use technical analysis, you can kind of gauge who's going to go bankrupt and who's not going to go bankrupt. If they're going to go into bankruptcy, because you'll never get a bounce, you'll never get the money coming into that stock, the volume and the flow. Then you're like, I'm going to avoid that one. It's not getting any action. Like you said on the EKG, you get that spike. You'll get that spike off the bottom and volume and stuff. It'll come in. It's like, oh, this is going to go. So I think you want to use technical analysis. I don't think it's the end all be all, and I would not solely depend on it because think of it this way too. If you're a hybrid and you can see the cycle coming before it kind of comes, it's kind of, let's say, leading indicators. You can get aggressive at a really low spot where you can put a lot of money at a very low entry point because you know that the cycle's turning. So you kind of front run the cycle. You front run the money flows in the technical analysis where you get legit breakouts, where you break a trend line. So those guys are all looking at trend lines and saying, well, when it breaks this, I'm going to go in. And it's like, well, that could be, a dollar or two higher than where I could potentially get it. But a dollar or two, if you're only buying it at like 50 cents and your multiples of what you could make on the upside are so great to buy it so cheap, I have found to take the risk, diversify it out, buy it at the lower cost basis, and get your bigger multiple of the upside. I think it's completely worth it. So that's my opinion on it. Buying it at 50 cents versus $1.50, and the stock goes to $20. I mean, that's a huge difference in terms of multiples of what you make. So I look at everything from an engineering perspective, but I'm also not a hardcore like I'm not hardcore math. I know this is not hardcore. It's a soft science to some degree and a lot of psychology and sentiment baked into the cake here. So I always looked at it as when you're coming down and you could look at leading indicators like what is the root cause of getting a perfect bottom? What does that look like? What does it feel like? And no one could really tell me that. I always had to learn it on my own. It's like I didn't have a mentor, and I don't even know if the mentors know that well. Some of these really good guys, I think they're all kind of trend followers. They're early trend followers to some extent, some of them, not all of them, but some are pretty good. But it's like what's the leading indicator? And it's all rooted in cycles, ratios will tell you with extreme certainty, yes, you are cheap. Like oil right now is cheap. No matter what you look at in history, it is cheap today. 40 to 1 ounce gold, 40 barrels of oil. That's cheap. You cannot argue that. You can't be like, well, that's expensive. Okay. And then what people will say is a recession's coming, oil can get cheaper. It could, but it's at 40 to 1. It's cheap already. So that's some things that keeps me grounded, keeps my focus in the right direction of what's cheap. So hopefully that answers it. So yes, I think it's imperative, and yes, I think I completely implement it in my stuff.
All right. Thank you. Yeah, I didn't have anything else. I'm good. So
Okay. Yeah. So if people want to follow you, how do they? You've got a YouTube channel, I know,
yeah,
and
I'm on YouTube, Actionable Intelligence there, or my name, and on Substack. They can go there, Actionable Intelligence, or put my name. I'll pop up there. So that's where I have most of my stuff now. There's the videos you can watch. You can get. I have a free email that goes out every week. Then I have a paid subscription service, so people can avail themselves of that if they choose. So far, we've been able to uh, outperform the S&P tremendously. So hopefully that will continue.
yeah. Well, thank you for coming on, John. I really appreciate it. Thank you.
All right, no problem. Thank you.
See you guys.